Hello and welcome back to Channel 11. I'm Ken Shinoda, your host, and this is the April review. Today is May 2nd, the day after Fed Day yesterday, and I'm titling this Channel 11 Tranquilo, which is calm. And April was nothing but calm, but after Powell's more dovish meeting yesterday, I think some calm has come back in the market in the near term. Definitely not a good month for bonds. Here you can see interest rates across the curve coming back to almost test 2023 levels at the front of the curve. The long end of the curve still a little bit lower. The 10-year finding resistance at that 470 level that we talked about last Channel 11, last month. And the 2-year up couldn't break 5%, couldn't quite get back up to that 522 that we saw in October of last year. So we're going to need some inflation prints to the upside to maybe retest those levels. But for now, it seems like we're back to the trading range of the last couple of weeks. So after this big sell-off, you can see the change from 3 months ago when the market thought that we'd be all the way down at 386, which is over 100 basis points of cuts by December. Now we maybe have one cut by the end of the year. Fixed income returns for the month of April, just a bloodbath for longer duration paper with this big rate rise on the back end. You can see treasuries down 2.3%, agency mortgages down 3%. Non-agency short duration AAAs, they're short duration but still down 1.5 there. What's doing better are obviously floating rate assets, collateralized loan obligations, levered loans, IG long duration down 2.5, high yield. Even though spreads are tightening across many sectors, the duration move is overwhelming. So only if you were floating rate or very, very short duration did you withstand the move in April. Now, year to date, that brings the aggregate index through April 30th down 3.3%. It brings the higher quality parts of the market, treasuries, agency mortgages, you can see on the left-hand side, down 3 to 4%. Corporate bonds down about 3%. So floating rate, again, the winner yet again, and some of the laggards of last year. So BBB CMBS, which was a big laggard last year, is playing catch up as there's some risk on fervor and deeper subordinated credit risk out there. The land of gains, the S&P 500, it was not the land of gains in April. You can see the sad face over on the right-hand side. We're gonna look at the land of gains every Channel 11, and that face will change depending on the direction of the market, as well as the rocket ship, which is starting to turn down a little bit here. And so it's some negative sentiment and negative performance in risk assets. Equity performance, you can see most indices across the globe in the red except for the FTSE, EM flat, Europe doing better than the US, S&P down 4%, NASDAQ down 4%, even the Nikkei that had been on a tear down 5%. Small caps, the worst performer, down 7% on the far right-hand side, and that's month to date. So now year to date, still positive return for equities, but the Russell 2000, that small cap index, is now negative on the year. That small cap index, those are the borrowers that have to borrow in the floating rate markets. They don't get to access investment grade corporate bonds typically. And so those are the kind of borrowers that are going to the floating rate bank loans, they're going to private credit, private debt, and floating rate debt is expensive. Actually, a couple weeks ago when we had that CPI print, you had a big underperformance in the Russell because higher for longer is not good if you're borrowing floating rate. You have a bank, the average spend on bank loans is 500 basis points going back over the last decade. For all of QE, they were borrowing at 5%, and now they're borrowing it at north of 10%. So I think that's why you're seeing some underperformance there. Now going to the subsectors of the S&P. Again, most sectors negative except for utilities on the far left. But year to date, still positive performance. The laggards here, we see consumer discretionary is lagging, value is lagging, healthcare is lagging. Really, the momentum has been winning. Those high-flying tech companies, large cap companies, and energy, which was had really suffered for a while, is one of the winners this year as oil prices have risen. Commodities, this shows you that they're up on the month outside of agriculture and up on the year, but towards the very end of the month, we're starting to see a correction in some of these high-flying commodities. Here's the Bloomberg Commodity Index. You can see it tick down, but some of these real high flyers are coming off their highs. So crude oil, which at one point probably at the top here, Everyone was calling for $100 oil. We've turned over, we're down back towards 80. I was just in South America visiting clients, and hot topic down there was the cocoa beans, the chocolate, and how crazy expensive it was getting, because they do produce some cocoa beans, but a lot of it does come from Africa, and it's been going parabolic this year, and it's down massively off that high. Bitcoin, had its halving event, which was supposed to be bullish because the supply was going to halve, and I guess it was, buy the rumor, sell the news, because post the halving, you've seen weakness in the Bitcoin market. I like to look at Bitcoin as a barometer of risk-taking appetite in the markets. And on the right-hand side, semiconductors also had been on a tear. You can see that's been turning over. So a lot of charts out there starting to look like this. Doesn't mean that they can't bounce from here, but some of that real speculative fervor, equities melting up every single day, I think is starting to come out of the market. So it could be a choppier ride. But for now, after yesterday, there's a bit of tranquilo that the bond market and the equity market is enjoying, at least for today. All right, what looks cheap out there? This is the what looks cheap bond report, fixed income spread history, 10-year look back. We look at this every month. I think this is a great tool as we look at relative value in the fixed income markets. The lower the dot, the more expensive the asset class, and things have gotten even more expensive, if you can believe that, from last month. The prices are down because rates are up and duration's kicking in, but spreads have actually come in. So while IG corporates, investment grade corporates, are down almost 3% on the year, the spread is now 4th percentile. It's only been tighter 4% of the trading days over the last 10 years. So you're only getting 86 basis points of yield pickup. What's happening is people are not looking at valuation, they're looking at yield. They're saying, we haven't seen yields like this in a while, and so with rates backing up, I can buy an investment grade bond that yields 5.5%, maybe 6%. I can buy a high yield bond that yields maybe 7%, 8%. And I haven't had these yields in a long time, and I'm going to lock that in. So I'm not saying that's the wrong thing to do, but if you want to buy what's cheap, it's definitely not those markets that have tightened and spread. It's going to be what's the higher up things on this chart. So a lot of the securitized sectors, while they're playing catch up and they've been coming down this chart, there's still a lot of value in the securitized sectors. And of course, agency mortgages, lone wolf up there, cheap and getting cheaper. It's kind of been the value trap for some time, but the yield on the agency MBS index is now the same as the corporate bond index with no credit risk, and the risk of mortgages, prepayment risk, is very low. It's the lowest it's been in decades, as we've looked in some other Channel 11s, because prices of bonds are so low, borrowers have such low coupons that mortgage rates could fall hundreds of basis points, and most of the mortgage universe can't refi. So this is where we see the value. Here it shows you how spreads have tightened, and you can see year to date, CMBS, we saw that was one of the places that was winning, was CMBS BBB. Spreads have come in a lot there. EM sovereigns, one of the laggards, the spreads month over month widened there, and agency mortgages also widening, which is why they've cheapened very recently. This is showing the securitized sectors versus corporates. We look at this not every month, but we've been talking about how these lines should come down as investors see the relative value, and they continue to come down. It's just that corporates have tightened so fast, so quick, and keep tightening that it's going to take time for these to play catch up, but they will continue to play catch up, which is my base case for these sectors. In the meantime, you have extra yield with typically less duration. So I think it's a great place to invest right now. I was on Bloomberg yesterday and was asked what kind of credit we like. We really like shorter credit, the top of the below investment grade market, think double Bs, all the way up to, let's say, double As, this kind of higher quality credit, investment grade with a little bit of below investment grade, where you can buy on the front end of the curve that's the highest. The 2 year is around 5%. You can pick up 150 to 250 basis points. So you can buy 7.5% type yields in what we believe are high quality bonds with very low risk and very low interest rate risk. Looks pretty interesting right now. All right, well, the Fed meeting was yesterday, and inflation is kind of going sideways now, which is why the Powell didn't cut rates. But I think the dovish surprise is that people thought he might come out hawkish, and he was pretty neutral to slightly dovish, I would say, saying that we're going to keep rates where they are. and that inflation's come up a little bit, but we've made meaningful progress, and we don't think we need to raise rates. We think we're sufficiently restrictive. And so the base case right now by the market is that we may see one cut towards the very end of the year, like in December. But we've got plenty of months for new data to come in. So let's talk about what's been going on. Well, goods inflation in the gray on the right-hand side has been coming down. It was like the supply side issues. And with manufacturing, PMI is coming in sub 50 for 16 months almost until last month. It turned positive, and then now it's gone back slightly negative below 50. Yesterday we got the PMI numbers. That's helped bring that goods inflation down. But what's sticky is services and shelter. And shelter works with a lag. And I do think shelter inflation will eventually come down. And so we'll look at some slides and see why. So here you have the blue is owner's equivalent rent. That's what is reported in the CPI. And in the big mountain you see is the CoStar asking rent growth. So CoStar is a system that we have because we invest in CMBS, and it gives you data about the commercial real estate markets, and it gives you the asking rent of multifamily. And you can see in 2021, asking rent of multifamily, this is the percentage increase on a year-over-year basis. You can see we got to a point where it was going up 10%, and that's very, very high. And you can see that it took a long time for that blue line, the CPI index, to kind of catch up. And while rents are still going up, they're going up at a slower pace. So you're no longer seeing these kind of 10% annualized increases in rent. Now it's like 1%, 2%. And so that means that pace of change has slowed down. That will eventually leak into the inflation. And Powell said that yesterday. Now we got to go to services. Service inflation is driven by wages, and wages have been high. The increase in wages has been strong because of the supply-demand dynamics in the job market. More jobs than people looking for jobs, and wages continue to remain strong as we see kind of 4%-ish wage growth. But there are some signs that there could be some cooling in the labor market. So here you see the quits rate. We looked at this last month. The number came down again, which means that the percentage of people quitting jobs is dropping because the grass is not as green anymore on the other side. And they can't find a job as easily. They're not going to get paid more, so they're less likely to leave their job seeking somewhere where the grass is greener, right? And so you can see a pretty good correlation on an 8-month lead with the Atlanta Fed wage growth tracker. So while this is not meaning that we're going into a recession, it could mean that the pressures on wage growth is coming down, which will help that services inflation come down. We also looked at this last year. This is small business hiring plans. Small business is about 50% of employment in the U.S. From the mid-90s till very recently, it's been about 65% of employment growth out there, or of new jobs. And you can see that small business is not looking to hire, I think largely because the cost of debt is so high for small businesses. They got to borrow probably in the low teens, or at least high single digits, and so they're less likely to hire. So again, cooling in the labor market. Going to take time to come through in the inflation numbers, but this is positive. Job openings versus job seekers. We're almost back to pre-COVID. So it got crazy because a bunch of workers left the workforce. We looked at, many years ago, back in 2020, 21, we looked at some charts of demographic trends of baby boomers leaving the workforce, and that is happening, aging demographics. So people leave the workforce, but now you're seeing that job openings coming down. We're coming down to the low 8 millions, and that's normalizing. We need this to keep going down, but it's moving in the right direction. Now, one of the things that's going on that's bad news is that manufacturing PMI while it came in slightly negative on this last print, it was positive last month, and we get another point of data, which is the manufacturing prices paid. And that has been above expectations the last 2 months. And if the economy is not in a recession, eventually companies that were putting off some CapEx, buying some machinery, buying things that they need for their business to expand, eventually if there is no recession, they got to get on with life and they got to start investing in CapEx again, and then the orders for new goods can pick up, and that's kind of what's happening out there, I think, in the manufacturing world. So the prices paid has started to go up, because it's not just the US that is recovering, global manufacturing has also picked up. So as the global manufacturing industries all start to turn things back on, the prices of the things they need could start going up. So that's why prices paid has gone up. This is potentially bad news for core goods. This is the wild card, I think. If core goods starts coming back, then we're definitely not getting to the Fed's inflation target, and that's when I think hikes could come back into play. But right now we're not there. Hikes are not my base case. I still think we're going to be higher for longer, and if the data comes in as the Fed wants it to, then we could have potentially one cut towards the end of this year. If data comes in worse, obviously we can have more cuts, but right now the market, and I agree with the market that it's at best one cut towards the end of this year. Something else that could be potentially good for inflation is that if you look globally, and this is Europe, this isn't global inflation, inflation is coming down everywhere else. It's coming down faster in Europe. That's why they're probably going to cut before us. They're probably cutting this summer based on what the ECB has been forecasting. And it's good news because there's a global trend of deflation. The bad news in the US is the reason we have more growth is that we did more stimulus. So there's all this liquidity and money out there. There's the excess savings that maybe hasn't all been spent. There's the fiscal stimulus that's still out there, the CHIPS Act, the Inflation Act that's creating more inflation. And that's the bad news. And again, watch that core goods, watch that manufacturing sector. If that picks back up, that is not good news for inflation, and that would cause, I think, another hike to potentially be priced in. But again, we're not there yet. And with the rates back up, the dollar remains strong. Here you can see the 10-year yield with the dollar. And last but not least, we'll just touch on gold. Gold's been on a tear, and I think one of the reasons gold's been on a tear is there's a lot of demand for different countries that the people there are tired of the currency going down, Japan being one of them. Look at gold in Japanese yen. The yen is got to 160. Actually bought some around 155 because I'm going to go visit some family, and it's so cheap right now versus history. I used to go visit my family there in the early 2000s, and the yen was around 80. It's 50% cheaper right now. So it's a great time to visit Japan, but it's going to be crowded because everyone's got the same idea. But it's a beautiful country, so I hope everyone gets to go there sometime in their life. But I think a lot of demand for gold has been from a global, certain parts of the globe where countries and people in those countries want something stable, that their currency continues to depreciate. And that's why investors diversify into dollars in emerging markets, and gold is another place to put that money. So that's gold. It's gone up a lot. I don't love it at the levels that it's at today, but it's hard to see pressures of that coming down meaningfully. I think it's not going to behave like Bitcoin. So Bitcoin is not the new gold because it's going down and gold is going up. So gold is winning this year at least. So that's it for Channel 11. Good luck. Hopefully we'll have some Tranquilo out there, and good luck trading.